Morning, everyone, and thanks for joining our tax planning webinar for the 2024 tax planning season. There's still a few people joining, and what we'll do as they join, see if the little trick thing here works. Let's so on the screen, you'll be able to see a map of Australia. There we are. Cool. And if in the chat box, let's try this out. If you type in the location you're calling or you're zooming in from, should start to see on the screen a few. Yep, Brisbane. Cool. Oh, yeah, there's someone. But yeah, if in the chat box, if you type in the city, or it might even work with towns, this one. There you go. Ah, good to see you, Howard. Redcliffe. Cool. There we go. We got people coming in from all over Australia. Sweet. How's the temps in Adelaide? Whoever was from Adelaide there. Laura, they're dropping down pretty fast. I'm heading there in a couple of weeks. Cool. Still got a few more people coming in. Robbie Island, cool. And if you haven't already, feel free to grab a cup of water or coffee, tea. Aroma, there you go. We're going to be kicking off for about 45 minutes to an hour, depending on the questions that are coming through. Where we're going to go. So the other things to keep in mind is if you pop your camera on, yeah, it just feels a bit more workshopy rather than a webinar where it's just sort of one way. I love to sort of keep these things interactive. So thanks Ben and Howard and Tay and Rose for cameras. Yeah, just love to see smiling faces and get some interaction if we can. Thanks, Laura. The other thing with this is I'll be presenting a little bit differently than normal. So you can see the slides that side of me. I won't be sharing my screen. So the best way that this works is if Zoom is in full screen. So you may want to adjust it to that if it's not already showing in full screen already. Hey, Carly, thanks for the heads up, listening in the car. Cool. Cool. Pauline, Dana, cheers. So geez, there's still more people coming in. There we go. And my notifications. Thanks, Rose. That might stop it. Cool. All right, so we shouldn't get any more notifications, noises. Daniel Main's joined. There we go. Hey, Daniel. I think something you've helped me out with is arriving today. Thanks very much. An AI assistant. I'm still creeped out by those things a little bit. Hey, Phillips Autopilot. See that in the chat box, unless that was a direct message and no one has any idea what I'm talking about there. Yes, it is a direct. No. Oh, cool. All right. Well, we might get cracking. There might be still some more people join as we go, but anyway, yeah, just a reminder, cameras on, ideally. It feels more like a workshop than just a one-way prezzo. The other thing is Zoom full screen, just because of the way I'm sharing my slides. It's going to be way better, and you'll be able to see the detail that way. And then the chat box. So I'll be keeping an eye on it, and then we will be doing Q&A. If there's a question that pops up that relates to another section of the slides of the webinar, something I'm not at, then I might just wait for that. But otherwise, feel free to pop questions in as we go. And before we kick off with our tax planning webinar, I do want to mention a webinar we've got coming up on the 2nd of May, 2024, which is all about unlocking business growth through the help of virtual assistants and how they drive efficiency and cost effectiveness. And we're actually presenting this with one of our clients who is an AFR fast starter, yeah, they've grown their business extremely quickly over the last few years, but all helping businesses in Australia grow through the help of virtual assistants. So if you do want to join us on that one, Tay from our team has just posted the link to register for that in the chat box. And then the other thing is, yeah, there's quite a few names I haven't seen before. We've got a couple of clients in joining as well. But for those who don't know who Inspire is, we're an accounting firm based in Brisbane, and we help. Our focus is on helping business owners all around Australia. One of the things that we focus on is saving our clients a heap of tax. That tally of how much tax we've saved our clients so far is sitting at about $29 million since we started counting in 2015. And we're actually about to enter our tax saving season. In fact, we've started already. The team have started delivering their first couple of tax planning meetings with our clients already. And we expect this number, or the goal is to actually take that number from 29 mil to about $35 million over the next few months through to 30 June. In terms of a personal intro, yeah, my name is Ben Walker. I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with over 17 years experience, and I'm the author of Wealth for Life and also the book It's All Sorted, which was more recently published. And here's a photo of my beautiful family. This was taken in December, but yeah, we've just some other special personal news. We've got our fourth baby due in less than 2 months, which is cool, but also scary at the same time. But anyway. And if anyone does want a copy of It's All Sorted, so this is a book where I sort of detail the stuff around just the basics of what you need to keep in mind as a business owner from an accounting and tax perspective, but it also gets into business structures. So things like companies, trusts, how they work, what this whole idea of asset protection is and how that might help you. And then there's about a third of the book dedicated to tax saving strategies. So some of those we will cover in our webinar this morning, but there's a whole heap more. The webinar this morning is for tax planning related stuff, but the book goes into a detail on stuff that might be a bit more relevant throughout the remaining business life cycle when it comes to tax strategies. Cool. Alrighty. So what we'll cover, so we're going to cover what is tax planning. Then we're going to get into some some time critical tax saving strategies, the impact on ATO. So the ATO attack on trusts. It sounds pretty violent, but yeah, there's a bit of. It's not new legislation. It's that they've changed their perspective on decades old legislation called Section 100A, which I'll sort of go into, which basically means we can't do certain distributions from trusts like we did before. The next one here is recent changes, such as how are the stage 3 tax cuts going to impact us? And then we'll sort of have options or opportunities for Q&A as well. So that's what we're going to run through. Yeah, there's still a few people joining as we go. Welcome to those who've joined so far. All right, so what is tax planning? Tax planning is a process that accountants can help business owners, or even it doesn't need to be a business owner, that's just who we happen to work with. But the process that we do is from March to June each year. So our preparation time is March, and then we kick off the season, so to speak, in April. And the process is actually meeting with every single one of our clients to go through, and we want to work out what's their estimated profit going to look like for the group, and therefore what's the tax outcome going to be on that estimated profit. Now, in terms of how we estimate profit, we've got 3 quarters of actual data so far for this financial year. We've got September quarter, December, March, and the June one is what we have to estimate. So we do that in tandem with our clients. We make some assumptions based on what we've got in the past, but the goal is to just make sure we check those assumptions with our clients to be able to ensure working as accurately as possible with that estimate. And then the tax estimate comes as a result of that. Then what our team does is work through different strategies and things we can do to, I guess the goal is to end up dropping the tax bill as much as we can. And then once we've had that delivery meeting. Then the process is anything that needs actions after that point. We need to make sure that that happens usually before 30 June in most cases. So whether it's moving cash around or preparing a certain distribution statement, dividend statement, things have to happen before 30 June in the financial year for us to make sure that that all takes place. So I'm just getting that chat box in a better location for me. Very good. All right. Now, next one here. So yeah, just an illustration of that. If a client group's got $300,000 in taxable profit, and what we do is we look at all the companies, trusts, business entities, investment entities, the individuals in the family group, and we look at taxable profit and therefore the tax on that as a whole, because we're working for the family, not just one single entity. And then the idea is, what do we do? What strategies do we have to reduce that tax bill? So again, this is just trying to illustrate something. But if we start with a 75 grand tax bill, we end up with a 50 grand tax bill as a result of those strategies. Then the value of that tax planning process is 25 grand. What we do is we record this number for each of our clients, and that tallies up to and heads towards our tax saving tally. Hey, Elisa, so good to see you. Thanks for joining. All righty. I guess the number one thing that I want to sort of share, and if this was the biggest takeaway, it's not about any one strategy in particular, but it's more so that if you don't normally do a tax planning process, but you think you need to, or we believe that every business owner should be doing this, but if you're going to do this process, what I would strongly recommend is that you start way before 30 June, because most of the strategies we'll run through today need to be implemented, actioned, and sorted before 30 June. In fact, we're mid-April at the moment. Tax planning is not just a quick phone call with the accountant. If it's going to be anywhere near structured or good. As early as possible is the goal. The other thing is, from a cash flow perspective, you may need to move some money around for a variety of reasons, or spend some cash, whatever it is. So it's not like with as much time as you've got, the better the outcome is going to be. Alrighty. So let's switch gears into some of these tax savings strategies. All right. So the first one we'll run through is writing off bad debts. Now, this might sound strange or weird that I'm suggesting this, but to write off a bad debt and deduct it for tax purposes, there's a couple of things that have to happen. But the biggest one is it's got to be written off in the year that you want to claim it. So if you've got a debt that's from 8 months ago or 12 months ago, or a couple of years ago that you're likely never going to get paid on, but it's still showing in your debtors, and you haven't written that off, then technically, if we're doing the accounts, that your tax returns in September, technically we can't go and write that one off retrospectively in the previous financial year. You have to have written it off in the year to claim that. So my recommendation here is to run your accounts receivable report, and you can usually run that in an aged way. So you can see 30-day accounts, 60-day accounts, 90-day, or depends on your software. You might have the ability to run different time periods. But what you're looking to do is look at the really old ones, and just check, are you actually going to get paid for each of those? Now, ideally, you would have attempted a few times from a commercial perspective to go and recover that money. But again, if it's unlikely that you're going to get paid on that one, we want to make sure we write that one off. Now, I'm not suggesting we be silly here, but let's say we write it off now, and then in July, somehow you get paid for it. Then we just re-raise that invoice and make sure we pay tax on it. We can't be silly about things. So that's one of the first ones I want to kick off with. Again, it's a time sensitive pre-30 June one to make sure. Next one here is gift cards under $300. This isn't going to save you $10,000 in tax, but it might just help out a little bit. But basically, there's a fringe benefits tax exemption for gift cards under $300 for employees, and you don't have to, but you can buy gift cards for employees, including if you're an employee of your own business. And have that as a tax deduction, and then no FBT on that. Now, I need to be careful with that. That's not $300 gift cards times about 20 of them to have a little deduction for yourself. It's $300 per employee, so you can't just go and load up your grocery bills on gift cards and expect that that's going to be a deduction, unfortunately. But yeah, another thing that might help out a little bit. Another one here is prepayments. So as a small business, you've got two different options of when we deduct an expense. The first one is when it is incurred or when it is paid for. Now, there's a couple of asterisks, of course. There's a turnover limit, which is huge. But the idea here is that one of the other asterisks is that you can only prepay up to 12 months worth of expenses. So if we think of things like rent payments, and often when we're looking at tax planning with business owners, the people who are concerned about tax often will have large tax bills, or you've had an abnormally high profit year, which means you're going to have a higher profit. A higher tax bill as a result. Now, prepayments are a way of, what's the word? Not making the differences between the years from a tax perspective so vast. So if we've got a big profit year this year, but we're expecting next year to not be so good, maybe a couple of big projects came off, or sales were abnormally high that may not continue. So this year's your tax problem, not necessarily next, or it's expected. Then prepayments is another way of pulling the deduction forward from next financial year to this financial year. Now, it is a strategy we can do every single financial year. So technically, we can just, always bring forward next year's prepayments. And often we see this, with things like rent. So again, you can prepay up to 12 months of rent for your business. The other one here is if you have travel early in the next financial year, say it's September, October, even November, if you prepay for that travel, flights and accommodation, things like that now, then yeah, we can deduct that now as a prepayment. Yeah. The other thing, this year, it sort of is a little bit more beneficial to prepay than in previous years. Now, I'm going to find the slide. Now, you might have heard of the stage 3 tax cuts, where basically our tax rates are changing. Now, we'll have this slide later, but I want to illustrate that prepayments are quite relevant this year. So we're going from these rates here. This is the 2024 financial year we're currently in, and we're going to these rates. And good old Albo adjusted the stage 3 tax cuts. Now, I think for most people, it's a good thing. But if your personal taxable income is in excess of 150K, that's where you lose out in these tax cuts. But what I'm looking at here is the difference between the tax rates means that for most business owners, every dollar they prepay for this financial year, they're going to be up an additional 2.5% versus paying that same expense next year. So again, illustrating that or contextualizing it is if you prepaid 10 grand worth of rent that you'd normally pay in July, you just pay it a month early, then your net benefit is not only the prepayment tax planning strategy that's going to drop this year's tax bill, but on top of that, the difference in the tax rate means that you'll be up another $250, as if you would, instead of if you were to pay it next year. So I'm hoping that that's making sense, is that not only the prepayment helps with timing of the tax bill, but it also this year, it's going to help because there will be an additional difference in extra deduction we're going to get if you're one of the people in the income range where you'll get that extra 2.5% deduction. Cool. Alrighty, now I got to go and find the slide I was at. All right, prepayments. Very good. There also, just before I get back into this, there's also been a fair few people join even now. So if you've missed the first little bit of the webinar, we will be sending out the recording so you can catch up on the first sort of 15 minutes or so. And we usually send that out same day. No pressure, team. But alrighty. So next strategy is cashing up your super fund. Yeah, what this one is basically there's tax deductible super contributions that you can make that will reduce your outside of super taxable income, and you'll get a deduction for that. Now there's limits for individuals, and the rate is currently $27,500 per year of that tax deductible contribution amount. Now, the good news, again, there'll be a slide soon, that rate is going up from $27,500 per person to $30,000 per person from next financial year onwards. So that's, I guess, good news for people who make use of that superannuation deduction. Now, the other thing to keep in mind is we're also able to use a catch up. So if you haven't maxed out your contributions, you can roll forward the difference between the cap and what you actually claimed for up to 5 years. Now, there are rules around that. There's age requirements and total balance of your SMSF requirements. But if you've got if you know you've got a bit of super contributions that you've missed, in a fair few cases, not as all lost, so we can carry that forward. Now, the other thing with super contributions, and yeah, this one's fairly technical, but when a superannuation fund, and I'm talking in the context of self-managed super because that's what we help our clients with, and this strategy is easy to apply in this context. But with a self-managed super fund, the fund has, I think it's 28 days to record the contribution to the member's account. Now, what we can do is double up your super contribution cap in a single year. Now, how we do that is, let's say we're in the middle of June, so June 15th, we can put 27.5 grand, assuming you put no other contributions in. We put 27.5 in, but we can also put 30 additional grand for next year's cap, and we can claim it as a tax deduction when it's paid, but the fund has 28 days, i.e. can wait till early July to go and apply that to your member balance. So we call it a reserve strategy with super, but it's a way, again, more relevant for the big profit financial years where you're looking to, reduce the current year tax bill. But that's the way we can essentially double, or a bit more than double in this year's case, your annual super contributions. So, yeah, may or may not help. Did that, for the people who've got cameras on, did that sort of make sense? Cool. Awesome. Very good. All right. So, yeah, cash up your super fund if you want to. Can't give financial advice, but I can tell you what the tax impact is. All righty. Next one here is the EV, electric vehicles, and the FBT exemption. Now, this is not a new thing. I think it was released feels like about a year or more ago. But basically, electric vehicles up to a certain cost have an FBT exemption, fringe benefits tax exemption. And again, like we've done a table to illustrate the difference of what this could mean. But essentially the same, a 77 grand car with no exemption is costing you an additional 15 grand in FBT, but you get tax deduction for that. So it's not just the FBT as a direct cost. Basically, the difference in the illustration we put together here is you're better off with the FBT exemption by about $11,000. Now, I think we've done this preparation. One of the team prepared this for me, and I think it's sort of showing the absolute most beneficial situation. So if you've got a cheaper EV, or you've got less personal use on a car, it may not be as great as this. But again, something to consider. That's newish. And I'm just getting feedback that the table is blurry. I cannot display it any other way, unfortunately. But yeah, if you are considering an EV, then the fringe benefits tax exemption may assist in terms of making that a bit more affordable. Alrighty. The next one here is the small business skills and training boost. This was announced as a COVID measure, and the reason why I'm bringing it up is because of this thing down here. It finishes soon, so we don't have too much long left of this. Now, what the idea of this is you can claim an additional 20% of expenses for basically training your team. Now, it can't be training yourself as the director or owner of a business. So you've got to invest in your team for this one. And the other one is it's got to be paid to an RTO for something RTO-ish, like a certificate 3 in plumbing or that sort of thing. It's not necessarily business coaching or training like that. It's sort of formal qualifications. So a lot of our trade clients are sort of leaning on this one. Any professional services, it's not super relevant for unless it's sort of certificate-based RTO vet style training. And yeah, the time it finishes is 30th of June. So yeah, and again, keep in mind it's just an extra 20% deduction. So this one is something I wouldn't recommend rushing out and doing unless you've got a business commercial need to do this sort of thing. Let's say you were going to chuck 2 or 3 team members through a certificate 3 later this calendar year. Well, if you do it pre-30 June and pay for it all, you just get an extra 20% deduction. So yeah, one to keep in mind. The next one here is a small business energy incentive. So this is an additional deduction of 20%, like it was in the previous one, but it's for stuff incurred on spending that supports electrification and more efficient energy use. So a sort of really obvious expense here is things like a solar system on the roof of a warehouse or building. Not the home office, unfortunately. I wish. But the other thing to consider is, and I think the terms of this is quite broad, but there is definitely fine print. So I would explore that if you're going to lean on it. But it's also, my understanding is it also includes energy efficient appliances as well. So if something needs replacing and you replace that with an energy efficient substitute, then we should be good to go with this one. Now, both the last incentives, this extra 20% thing, they're claims that are put in when we do the tax return. So if you're going to or intending to use this energy incentive or the training boost thing I mentioned earlier, just make sure 2 things. Ideally, just check with your accountant that you tick all the boxes. That's the first thing for whatever you're looking to spend the money on. The second thing is make sure you flag the expense with the accountant. We're not going to be able to tell if a fridge hiding at the back of office expenses randomly is going to fit this thing. So yeah, please flag it if there's any expenses that might be relevant for this or the training. Training is a very obvious account that we do check for the training boost stuff, but yeah, it's always better if we can share that, or our clients can share that info directly with us. Alrighty. Sweet. So that's a sort of handful of tax saving strategies. What I want to do is get into sort of recent changes, and this, yeah, again, some of these are really recent. Some of them are the last year or two. And I might kick off with the impact of Section 100A, which I'm sure that some of our clients may be aware of. But basically, the ATO have copped a lot of crap for this, but they've changed their mind on how they perceive legislation that was brought in, I think, in the late 70s. So Section 100A of the Tax Act. And basically what it's saying is that if you distribute from a trust, you have to pay that money. The economic benefit of that money has to flow to that person. Now, we've in terms of how we've approached this, our previous view before the ATO was so explicit on it was basically that we want to make sure that if you distribute from a trust to a person, we want to pay the cash. So that there's a trail of it, and then there's no increasing loan on the balance sheet over years of, hey, my son was owed 10 grand from this year, and for the last 10 years we've done that strategy of allocating him 10 grand on paper, but never actually paying the distribution through. And a really horrific example of where that went wrong for a family is, and I learnt this at uni, but the son fell into drugs and ended up meeting a lawyer who talked to him about accessing this loan that was built up over years. And the lawyer assisted him suing his parents' trust of and sort of successfully getting access to that money that was banked up and owed to him. Because when a trust makes a distribution, that person is presently entitled to that cash. Even if it's not paid, it's a present entitlement. So we want to make sure we previous to Section 100A, we need to deal with these loans, but the ATO has been a lot more explicit that we really need to make sure that the cash goes there soon after the distributions. So in terms of practically how we deal with this, distributions between yourself or your spouse from trusts or from your trust is easy. It's fine. It's normal. Paid into a joint account, running your family expenses, that's straightforward. Where we're paying adult children, and let's say we distribute 10 grand to them, like I gave an example of before, we need to make sure that the money goes to them, and gifting is not allowed, or repaying that back to you is not allowed. That's what they've said. The next one here is your parents / in-laws. Again, it's sometimes what we do with our clients, have good relationships with their parents or in-laws, and they distribute money to them. Again, the cash has to go to them. No repayments, no regifting back to you. The other silly thing is we can't even retain cash in the business for working capital in this situation, which, for clients who operate in trusts, all the profit at the end of the year needs to allocate out to beneficiaries. So it's owing to them. And what this says is we can't even retain cash allocated to certain beneficiaries for working capital purposes. So again, this set of rules, clearly accountants aren't stoked with. So clients are very much not stoked with either. It changes the way we've had to do things ever since I've been in accounting. And there is a fair bit of pushback. Where this ends up going, who knows? But the ATO have been very clear that here's your set of rules. Here's what should have happened since 1979, I think it was. There's a few unhappy people about it. But anyway, the goal here is to just make sure you've got a handle around it, and it just may look different in terms of how we distribute from this financial year onwards. Alrighty. The next one here is the stage 3 tax cuts. So I briefly mentioned these before. Again, the majority of Australians will benefit, and it works up to be, so in this table, which has this table, it's still a little bit blurry. Or is it okay? It's okay. Cool. Thanks, Elisa. So we've got taxable income. So if your taxable income sits at this is the difference between what was proposed and what the new tax cut is. and then the difference. So this is sort of Albo's impact on what he changed recently. So you can see that all the way up to 110K so far, you're better off. If we flick over to the next slide, we've got the point is about 150 grand. It starts to be worse off for you. But the tax rates generally are coming down, which is great. I guess the good news for those earning 150K plus. The big one here is, well, a couple of things. The 120K taxable income, if you are at that point in the current financial year, you're paying 32.5 cents in tax plus 2% Medicare levy, or 34.5%. Now, if you go up above 120K, you're in 39% tax, so 37% tax plus 2% Medicare levy, so 39. So it's a big jump up between that bracket and that bracket. Now, what we can see here is that the 120K limit or threshold or bracket is now 135. So that's a few extra dollars as a win. But the other thing is the 32.5 cent plus 2% Medicare levy is now 30% plus 2% Medicare levy. So this whole bracket has reduced in its tax percent, which is a great outcome, I feel. So everyone, so even if you're earning 150K plus, you'll feel the benefit of this reduction here. So yeah. Alrighty. So again, for those who weren't who joined the webinar before I shared this earlier, what that means is the difference in tax rates for most business owners will mean that for every dollar you pay this financial year, you'll get an extra 2.5% deduction than if you pay an expense next financial year. So the point of sharing that is that prepayments are fairly relevant or critical this financial year. And the example given earlier was 10 grand in rent that's for July that you normally pay in July. Just pay it a few days or a month earlier. In June, you'll get a 250K extra deduction between the two financial years. Alrighty. And so I've just seen a question from Ryan who's asked, what happens if you have a signed doc from the beneficiary saying that they do not need the money now? And unfortunately, that sort of thing doesn't or hasn't. There's been loads of suggestions like that or similar to that, but unfortunately, the ATO's stance is not sort of just ignoring any sort of way like that. So yeah, we've been told got to pay the money and can't gift or reimburse or shout holidays or things like that. If there's sort of a traceable way that the money's come back to the key people in that trust, that's sort of getting around that Section 100A. Alrighty. This is a fairly significant one. So this is a change that happened effective from 1 July that went in 2023, which was basically the removal of the unlimited immediate write-off for tax purposes. So what the rules were, and this was a COVID measure, was that the rate of instant asset write-off just went up and up and up throughout the years of COVID, and to the point where it was unlimited. So you could buy a $20 million truck in the right circumstances, if there is such a thing. There will be. But you can buy a $20 million truck and claim the whole thing, assuming it's all business use. Now, the rules changed from 1 July 2023 to say that the immediate write-off is now $20,000. So if you buy a ute for 19 grand plus GST, after that point, cool, you can claim it. But the moment you buy, any sort of vehicle above that 20K mark, we need to be mindful of this 20K limit, and this is the next GST if you're able to claim the GST. Again, things like laptops, it won't make a difference to. They're going to be under 20 grand. But it's that sort of big stuff that, we had tradies, buying a ute for 50 grand and fitting it out with 20 grand worth of stuff on the back. And unfortunately, we can't claim that whole lot like we would in previous years. Now, my suspicion or expectation is that this year, Businesses who rely on capital expenses, where the instant asset write-off has heavily benefited them in this COVID period. You're sort of, if this is you, you'll be pretty much used to claiming the lot up till this financial year. So be prepared that that it may not be as great moving forward. I was and a real example of this is we had a client who had about $500,000 profit, but they bought I think it was close to $500,000 in a truck plus a mulcher on the back. They do tree lopping and mulching. So their taxable income was like nothing. It was like 30 grand or 38 grand between the two of them. And anyway, so they were going for loans, and I thought, oh crap, they're not going to get something. But it's sort of getting a bit off topic, but depreciation for most banks adds back to your income. So they're fine. The bank sees it as $500,000 profit because they exclude that depreciation. But from a tax perspective, they would have paid next to no tax last financial year. But if they post the same $500,000 profit with no depreciation, they're going to have a very big difference in their tax bill. So I just want I want business owners to be aware of that, is if depreciation has been a big portion of your deductions in previous years, it may not continue to be if it's relating to assets that are above 20 grand. Alrighty. Next one here, again, something I did touch on before, but there's a bit more detail to it. So your tax deductible super contributions are going from 27,500 a year per person to 30 grand per year. These caps get indexed, and at certain points, they don't get indexed to the exact percent, but they get indexed each year. And if they trigger, I think this one must be a 2.5 grand step. If they get to at least 2.5 grand, they'll trigger up to the next 2.5 grand block. So it looks like that's hit the point with inflation where it's up to the next limit. This was 25 grand when it started, so it's already been indexed its first little 2.5 grand leg. So I guess that means, if you've got you and a spouse, or then you go from 55 grand to 60K total super contributions, or if it's just you, 27.5 to 30K for your super contributions. So keep that in mind. And again, it depends on how you pay yourself from your business. If you're an employee, you're probably paying a certain amount per already in your wages for your super. So you want to make sure you don't go above this cap unintentionally, because there is excess contributions tax on that one if it's not done correctly, or if you exceed it. And then the next one here is non-concessional. So these ones also got indexed as well. They were 110 grand a year for a while, and now they're going to 120K. Now that also means that the bring forward rule, and the bring forward rule basically says your non-concessional contribution cap times 3, you can bring forward and do 3 years in 1 year. So that's going from 330K, if you can do that, to now 360K. Allowing you to make a larger contribution. And it's not sheep stations, these contribution changes, but all these little things add up, and it's good to know, especially if your strategy generally is to sort of max out what you can do. All righty. Well, that's taken us to the end of the tax planning webinar, or all the slides I've prepared. We are open for a bit of Q&A. I do want to flag as well, if you are a client of Inspire, you should have, or in the next week or so, you'll be receiving a tax planning questionnaire to start the tax planning process. So we're already sort of starting that process for our clients right now, and you'll get communication about that if you haven't already. The next one, if you aren't working with us currently, but you do want to talk about what tax planning looks like with us, then feel free to book in for a strategy call, an initial chat with one of our accountants, and you can do that with the QR code or the link in the chat box. So feel free to do that. But yeah, I'm sort of free if anyone's got some questions they do want to ask. There's been a couple as we've gone. feel free to hang around. But apart from that, I've yeah, enjoyed sharing these strategies, and yeah, cool to see so many people join live. Um, and again, if you joined late or took off early, the recording will be in your email likely by this afternoon. Buddy, thanks, Elisa. See you later. Thank you. Thanks, Kylie. And Howard, there you go. Saw me at Portside. Yeah, there we go. Might have been on date night with my wife. Thanks, Amanda. Yeah, capex for zero tax will, well, if that was their tax planning strategy, will not enjoy this financially. Yeah. And again, like that sort of thing might change the strategy of, instead of upgrading vehicles or, that big capex, is to just not buy that stuff, because if you buy it, you've either got to finance it or pay cash for it. So it just might change people to continue using assets that they would have otherwise replaced, or getting more out of their existing assets. So some clients would buy those assets to continue growing their business. But yeah, it depends on the business itself. But whether you've got one truck and a mulcher that you know does two shifts a day instead of one, then you immediately get 50% or twice as much use out of it, depending on the situation. So yeah, there's different things for different businesses. Alrighty. Thanks, Samantha. Okay. Well, yeah.